If you've been watching this channel month in and month out, you've seen the process in my list of stocks, the 30 stocks that I want to own forever, and my list of 7 stocks that I believe will outperform the market's Magnificent Seven over the next decade. And every single month, I'm searching for businesses that get disconnected from reality, where fear, headlines, or short-term noise push the stock below its relative value. That's the opportunity. I have zero interest in speculating, and I'm not here to chase hype. I understand how difficult it is to be in that position, but I'm here to guide you along there. I don't need to buy whatever story Wall Street is selling this week. I want great businesses, and I only want them when the price makes sense. That's it. Now the question becomes, out of all the stocks on my list, which ones are truly trading at the right price? I'm going to show you 3 here in a minute. But first, how do I actually figure out what a company is worth? I do it very simply. I build out a simple 10-year projection on my assumptions of revenue growth, profit margin, and other metrics. And in this video, I'm going to show you how I do it. Because the only purpose of this video is to teach you how to fish. I am not here to hand you fish. And let me say something extremely clear. Do not buy a stock because I own it. Don't buy a stock even if Warren Buffett owns it. Don't buy it because someone on YouTube sounds smart. We're here to teach a process. That's the intelligent way of making YouTube channels. This channel is about process. You're watching how I break down a company, how I make educated assumptions about the future, and how I patiently wait for the price to go below value. So if you're new here, you're going to notice something very quickly. There's no hype. And the reason I teach this way is simple. There are too many people online committing what I consider to be financial manslaughter. They are chasing momentum. They're buying because the stock is going up, and they're selling because it's going down. They say that the stock is good because it's going up, and they say it's bad because it's going down. That's not investing, guys. That's pure speculation. That's pure guessing. Guys, we have 3 stocks that we're going to analyze right now, and I currently own all 3 of them. Stock number 1, PayPal. Guys, I'm going to keep this simple. PayPal is trying to grow again, not with hype, but with tools. They're adding AI to make checkout faster and smarter. They're improving their digital wallet. They're pushing Venmo much harder, which is massively successful. And they're expanding the buy now, pay later. What's the goal there? They want to make it easier for people to go on there, check out, spend money, and easier for businesses to accept it. Now, here's where it gets interesting. There's something called agentic commerce. That just means AI tools like ChatGPT that can shop for you. So instead of you searching, clicking, typing in your card, AI does it all. And starting in 2026, this very year, PayPal is expected to be the first payment processor built directly into ChatGPT. That's access to over 800 million users inside the app. Guys, think about that for a second. If AI starts doing the shopping, PayPal wants to be the button that completes the purchase. And they're also helping merchants get discovered by AI shoppers and handling fraud protection automatically in the background. Guys, that's extremely sticky. That's infrastructure. And to be honest with you, that's the reason I like PayPal. They're very big on their fraud protection. Now add this. Last week, Bloomberg reported that PayPal has attracted takeover interest after its stock has dropped nearly 50% from prior highs, over $40 a share. Guys, this is a stock that 4 or 5 years ago was over $300 per share. Now remember, that does not make it a value just because it's down that much, but it's definitely interesting. Now, banks have reportedly met with the company. At least one large rival is exploring a full acquisition of the company, while others may just want pieces of the business. Nothing's confirmed. It's very early, but the stock was up as much as 9% in the news. In fact, they halted trading to talk about it. So now we have a company that's down big. They're building new AI integrations. They're generating strong cash flow, and that cash flow is growing, and possibly now, because of the stock fall, drawing buyer interest. That story sounds exciting, but you guys know me. Stories don't determine what I pay. We have to put the story and the numbers together through Stock Analyzer. We make assumptions, we apply a margin of safety, and we determine the price that makes sense, not the price the market is shouting about. So let's look this thing up. They're now at $43 a share. Like I said, the low was $38.46 right here, just 10 days ago. All-time high, July 26, 2021, $310 a share. Guys, this is what I like. increasing margins in the last 5 years, even in the last 10 years, from 14% to almost 16%. You've got great free cash flow here that's above their net income. That's a positive. It's selling for 7.5 times free cash flow. 7.5, guys. Even a business that's not growing at all, zero growth, should sell for a higher multiple than this. Good margins, growing margins, revenue growth is still there. 6.4% a year for the last 3 years, 9% for the last 5 years. And the acquisitions weren't like a ton. It's $2.3 billion total over the last 5 years. Big community company with a buy rating. But again, we could be wrong, but the point is to find companies that are great and buy them. It's an 8-pillar thriller. Again, not a reason to buy, but it tells a story. This is what I love. Even PayPal knows they're cheap. They're buying back shares. Guys, when companies buy back shares, a lot of times they just buy them back to boost up earnings per share. But the smart companies buy it back when it's cheap. Alibaba is doing that. Adobe's doing that. PayPal is doing that. These are the things that make sense. Now, all these metrics can seem confusing. And if you're confused or overwhelmed, you're not alone. I was overwhelmed at one point. Even Warren Buffett, Charlie Munger were. We all have to start from somewhere. But I'm here to make it easier for you. I have all of these metrics in an absolutely free PDF ready for you to download. So if you want to get serious about investing, if you want to be the smartest one of your friends talking about these metrics, and if you want to understand companies as you look at them, click the link below. We will send you the PDF immediately, and it's a great way for you to learn. And guys, it's exactly why I teach on YouTube. I was sick of hearing all these so-called smart people talking about things and not making any sense, focusing just on story and not on price. That was very important to me. I'm here to change that. And in a couple of minutes, I'm going to show you the price that I'm willing to pay for the stock. But first, let's look at analyst estimates. Now remember, analysts are biased, but this is a company that everybody says is declining, $587 a share to $783 in the next 3 years. And look at the revenue growth, 2.5, 4.5, 5, 11. Guys, it's actually getting faster and faster according to analysts as time goes on. Could they be right? Yes. Could they be wrong? Yes, as well. But now, what I like to start with and do very quickly is our stock analyzer. This puts all of it together. To sit there, we make basic assumptions about the future just to decide, is this company worth spending more time on? So guys, what I like here is increasing return on capital. This means the business is getting better and better at managing its cash flow and becoming more efficient at it. This is what you want to see. First line here, revenue growth. Guys, I went conservative. I did 2, 4, and 6% revenue growth. And by the way, I'm doing a 20-year analysis. Let me go back down to 10-year. I usually do 10-year analysis. Profit margin and free cash flow. Free cash flow is higher than profit margin, so I'm going to focus on that. If it was the other way around, I'd still focus on free cash flow. Cash is the real, it's easier to manipulate the profit margin than it is the free cash flow. So I put 16, 19, and 22. They did 19.5% a year for the last 10 years. It is declining, which I don't like. So maybe I could understand the argument of going lower than this. PE. I want to look conservative here. Even though it has good returns on capital, I put it about the market average of 15 in the middle. I did 13 on the low side, 17 on the high side. Now, you're watching this and probably thinking, Paul, I disagree with you in some area. Fine. In fact, by the way, if you want to comment below about what assumptions you'd make, please do. And finally, my 9% no margin of safety return. This is just to see what is the intrinsic value of the business. What would I be willing to pay for this business to match the market returns of 9 or 10%? I hit the analyze button. Boom. This is why I'm interested, guys. I have a low price of 60 to 75, a high price of 118 to 160, a middle price of 85 to 111. Guys, again, I don't know if I'm going to be right on PayPal, but if I have 30 or 40 stocks that have these potential returns in them that are big companies like PayPal, I'm probably going to do pretty well. Doesn't mean it's a guarantee, but it's a good start. Stock number 2, Southwest Airlines. So this company is very simple thesis that I have. It's the kind of companies most investors scroll right past because it's not flashy. It is an airline, which is a very tough business. And there's no mention of AI, or at least very limited mention of AI. It flies planes from point A to point B. Before COVID, this airline was profitable 47 years in a row, which was not even comprehensible to other airlines. And that doesn't happen by accident. Their model is simple. One type of aircraft, efficient routes, strong brand loyalty, tight cost control by managing their hedging of fuel. Fuel is the biggest cost these airlines have, and they're very well known for hedging properly. They built a reputation for low fares and friendly service. Then COVID hit. Margins got squeezed, costs went up. They had some major operation hiccups, even starting before COVID. The stock was absolutely beaten down. But here's the bull case. Southwest has changed its business model in a big way. They've moved away from open seating, which makes me open to sitting there because I hated the open seating. And they introduced those assigned seats. There's premium legroom, check bag fees for non-credit card loyalty customers, even basic economy fares. Why does that matter? Because those things generate high margin revenue for airlines. Analysts are projecting stronger earnings. Some estimates are even pushing towards $4 per share in 2026. One price target, which you know how I feel about price targets, even moved up to $73 a share. They're upgrading technology, improving Wi-Fi with Starlink, and trying to modernize operations. Guys, Starlink is a game changer. I was using that JSX airline with Starlink during the Masters last year, and I was watching the final round of the Masters live on Hulu on my phone at 230 megabyte download speed. And compare that to like GoGo in-flight, it's a night and day difference. So if they're able to execute well and return to even somewhat normal profitability, today's price is very attractive. But there are risks, of course. Changing the seating model could upset loyal customers, labor costs are elevated, and debt has drastically increased. Boeing delivery delays don't help, and the competition in domestic travel is intense. This is a turnaround story. The question isn't whether Southwest is a good airline. The question is, can they execute this shift and restore strong profits? Now, we're going to take these assumptions and run the numbers. Guys, I'd love to run all of these, talk about all these numbers, but there's one metric here that I'm really concerned about, profit margin. Before COVID, this company did 10 to 15% very consistently. The last 5 years, they've done 1.4% profit. So my thesis is if they just get back to 9 or 10%, how much more valuable is this company? That's it. So as long as they're able to manage their debt, as long as they're able to do all these other things, then it's a pure play on margin, which has already started to turn around a little bit. Look at the 8 pillars. Nothing to write home about. It's 4 checks and 4 X's. I mean, it's just, there's negative cash flow, so it doesn't really it affects these 2 things right here. They're buying back shares, which I love. Return on capital last 5 years sucks. Why? Because they've had no money the last 5 years. They've had negative cash flow the last 5 years. But I truly believe this is changing shape. Analyst estimates. Guys, look at this. They're expected to make $2.70 per share this year. Some analysts have it higher, over $4 a share, all the way to $6.50 into 2029. Are they correct? I don't know. But even if they miss by half, and let's say they miss by half and it's $3.25, and you apply a 20 PE on that, that's a $65 stock right there. That's my kind of idea here. This is the idea that Monish Pabrai has. In my opinion, my pure opinion on this is I feel like this for me is a heads I win, tails I don't lose much. And if I'm able to do that 30 or 40 times, I'm going to do quite well. So let's go run the stock analyzer based on my assumptions to see how this looks. Because I want you guys to see something before we do that. They're at record revenue already. Record revenue. Before COVID, their maximum revenue was $22.4 billion. They hit that in 2020. They beat that in 2022. And they keep generating more and more revenue. So we go to stock analyzer tool. Let's pull up Southwest. The last time I did it in my history, 10-year analysis, 3, 5, 7% revenue growth, profit margin and free cash flow, 8, 11, 14, PE, 16, 19, 22, and finally my 9% desired return and no margin of safety. Look, guys, the truth is that most people are going to lose money with stocks because they don't have a plan. They buy the wrong companies, or, and this is what's more common, they buy the right companies at the wrong price because of hype. They sell it completely the wrong time because of fear. I used to do the exact same thing for years, and it really felt like the market was rigged to take my money. That was until I learned how to invest the right way. This is exactly why we built Everything Money, to help regular people like you stop guessing and start investing with real confidence. You're going to get our stock analyzer. our tools, our courses that teach you step by step. You're finally going to see the stock market through the lens of success, not fear, through the lens of an investor, not a speculator. Try it for 7 days. You'll see. This isn't gambling. It's common sense. I hit the analyze button. Guys, I have a low price of 66, high price of 195, middle price of 18. And again, if I'm able to have these returns on a portfolio of 30 or 40 companies, I'm just going to be like literally printing money, in my opinion, over a long period of time. But remember, we have no idea what happens in the short run. Now, this third stock, Intuit. The stock is down about 42% year to date. But check this out. As of this video today, it was up even further before. It was up to 372 today. 372. It was up over almost 4% today because of some partnership in AI. But again, year to date, down over 42%. What happened? Fear. Guys, this is the company that has QuickBooks. And I love QuickBooks. Investors are worried about generative AI that will make TurboTax and QuickBooks less necessary. That's why it jumped today with that partnership. The thinking is, if AI can do your taxes and bookkeeping automatically, why would you pay into it? That fear has caused a big reset in valuation. To which I tell people, yeah, maybe. That's a valid concern. Everything is a valid concern for AI taking over. But then I also say, wouldn't it be easier, just like for PayPal, if ChatGPT partnered with PayPal, for ChatGPT or other AI to partner with QuickBooks, who already makes the software to integrate into their AI? There's still going to be a need for that. There's also been rotation out of high multiple software stocks. When money flows out of growth and into safer sector, stocks like Intuit feel it. And guys, another comment I want to make. When the internet first came out, every article in the world was free. And everybody said newspapers are going to go to zero. And a lot of them did. But a lot of big newspapers went to subscription-based models. And that was not something we thought about when we first talked about the internet. It was free articles everywhere. There's going to be no more paid news and all that stuff. It didn't happen. Yes, newspapers went under. But the big ones, even Cleveland.com, you have to have a partner, you have to have a membership to get a lot of articles. That's the whole point of this. I feel like this is the same thing. Yes, AI will change accounting, but it's not going to be free forever. They're going to have to charge something because this artificial intelligence is expensive to run. So back to Intuit. Add in expectations of slower growth after a strong 2025 and you get pressure. But here's what matters. Revenue is still growing and so is gross profit. And they've beaten EPS estimates 4 quarters in a row. That doesn't feel like a broken company. And instead of AI, and instead of ignoring AI, Intuit is integrating it. They're embedding AI tools into QuickBooks and TurboTax to improve productivity and deliver better service. That's adaptation. They operate in a market with an estimated $300 billion total addressable opportunity. That's a big runway, guys. And to me, this is not a dying company. This is a wide moat business going through a valuation reset because of fear. Now, the question becomes very simple. At what price does that fear give us a margin of safety? That's what we're going to calculate next. But first, let's look at the numbers here. A couple of things I like. Higher free cash flow than net income. This is like Adobe, $6.35 billion last year versus 4.12 and 4.6 billion over the last 5 years on average versus 2.7. $100 billion market cap with $113 billion enterprise value. That difference of $11 billion is essentially their debt, which means they can pay it off with 2 years of last year's free cash flow. They've got a dividend, 1.2%. That's adorable. It takes out 1.23 billion of their 6 billion in free cash flow. Look at this profit margin. Last 5 years, 18.3. Last year, 21.2. Growth in revenue, 13.5% a year for the last 3, 20% for the last 5, 16% for the last 10. They do have 9 billion acquisitions though, so I'm sure that's helped out quite a bit. And returns on capital getting stronger. So overall, I'm liking this, and our community seems to like it too. They have an average intrinsic value of $615 per share, and it's selling for $363. But guys, it was $813 in July of last year. 7 months ago. 7 months ago, it was $813. Just shows you how fast things can change. So, let's go to the 8 pillars here. Actually, not all 8 pillars are checks. High PE, 5-year PE, because remember, their earnings are lower than their free cash flow. So that's why the PE is high. And, oh wow, they diluted some shareholders by 1.4%. That's interesting. So I'm not worried so much about this. And this is not a lot, but it's still something, just something to look at. Let me go see that. Let's go see if it's been a consistent thing. So we go to the income statement at the very bottom. Shares outstanding. Okay, they're buying back now. So 5 years ago, yeah. And then now they're buying back some more. Okay, this is good. So let's go to analyst estimates. According to analysts, this dying company is going to make about double profit in the next 4 or 5 years. According to analysts, look at these double-digit growth rates and look at the revenue growth rates. 13, 12.5, 12.5, 13.5, 10.5%. That's for the next 4 years. So guys, what do? We put it all together with my very conservative assumptions here. I did 10-year analysis. Now I'm going to sit here and go a little bit more conservative, actually. I'm going to do 5, 8, 11% revenue growth, profit margin, and free cash flow. I'm going to focus on free cash flow. I'm doing 28, 30, and 32. They did 30 for the last 5 and 10 years, 32 recently. So I'm like, okay, let's see if they can get bigger. PE. Guys, I put 18, 21, and 24. It's a high margin business that is, I think, a moat. If you ask 100 people right now, or 100 accountants, what's the most common software your clients use? I would be interested to see which ones don't say QuickBooks. And finally, my 9% desired return. I hit the analyze button. Boom. This is why I'm interested. I have a low price of $250 to $385, a high price of $580 to $855, and a middle price of $383 to $575. Yeah, guys, I really like this. So guys, you watched me break down 3 really strong businesses, but here's the thing. There's one more. And honestly, it might even be a bigger opportunity than 3 we just walked through. I didn't include it in this video because it deserved more time, more detail, a little bit deeper dive. So I made a separate video just on this one stock. If you want to see this company that I believe is trading at a discount from its relative value, if you want to see the numbers I made, the assumptions, all of the values I created, click the video on your screen right now. Thank you for your time.